Ladies and gentlemen, welcome to our second webinar brought to you by Bursa Malaysia. And today we're going to talk about stock investments. And the title for tonight is The Key to Success in Stock Investments. Now, we all know that it is important for us to have enough money to sustain in our life. But what happens when we have stopped working and we do not have income? And even if we have retired, do we really have enough money? So with me today is John Huo from Equities Tracker and myself, Benny Lee, and we're going to bring you through the contents for tonight, which is the key to success in stock investments, and we hope that today you will have the right key to invest in the stock market. So before we begin, John, let's ask the audience first and see whether they think that they have enough money to sustain their life, whether is for retirement or whether they have stopped working. So guys, please do participate in the poll so that we will see the results later on and see whether you guys are really prepared for retirement or not having an active income.
Please don't forget, all my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the half of the abuse.
Let's take a look at the results.
We don't steal outside.
I'm keen to see the results, Benny. So yeah, we have 80% who says no, they are not prepared, and 20% are prepared. Well, if you have the same thought of not being prepared, do not worry, because studies have shown that here 73% of basically young investors or young millennials, and probably also the older generation, are not prepared to invest or not ready for retirement. So do not worry about it, because today we're going to overcome this problem, isn't it, John?
That's right. That's
Right.
right. That's the whole reason for this webinar, actually.
So there are also a lot of people who do not have enough savings, and we're also going to talk about that later on. But for those who think that we have enough money, because we all probably depend on the EPF as our retirement fund, right?
That's right.
But the problem is the EPF really enough for us to sustain in our life after retirement?
Yeah.
Well, one of the problems with the current situation is the value of money itself. You know, the value of money 10 years ago is not the same as today. And this is caused by this thing called inflation. Am I right, John?
Inflation. That
So
problem.
what is inflation? Well, inflation basically tells you that the value of money has actually deteriorating as time passes. For example, the price of roti canai, the food that we all love, right? 10 years ago only cost 50 cents. And now it's going to cost us about 120.
120.
And it's probably going to be even higher now if you go to some places.
Look at the size, Benny. It's reduced by almost half, Benny. And
So
the price has gone up, but reduced by half.
So the price has gone up and we're eating lesser as well.
Yeah.
Well, so that's food prices, and we all know that food prices has gone up quite substantially, and that's one of our basic needs, isn't it? So we're gonna even look at property prices, which is also one of our basic needs, the need for shelter, right? Property prices has gone up quite tremendously in the
Wow, that's
past,
more than
10 over
240%.
years. Yeah, so if you bought a house, for example, 10 years ago, it's probably going to cost you about 200,000-300,000, and now it's all over $1 million ringgit, isn't it?
That's right.
So
That's
this
right.
is the effect of inflation, actually. So do we have enough to overcome this inflation? Because most of us will probably put our money in banks, isn't it?
Correct.
So if you put the money in banks, do you think, John, that our money is getting lesser and lesser, or do you think it really goes up if we keep it in the bank?
The old adage of putting money in the bank or even worse, stuffing money under the pillow does not work in the new sense of the economy, because inflation today, as we know it, it's eating up all our purchasing power. What is key in any financial health check for any individual is actually the purchasing power parity. And I think that's why the awareness of making money work harder and making sure the money works to overcome inflation is key.
So we really need to let our money grow, isn't it?
That's right.
Yeah, so basically one of the best ways to make our money grow is by investing.
That's correct.
So John, now we're probably going to explain to us, why do you think that investing in the stock market is one of the best ways?
Okay, so let's look at it. There's multiple ways of wealth creation. And a lot of people today, especially the younger generation, hope one day they'll open some tech startup, a Facebook, an Amazon, a Netflix, or even an Alibaba. Now, out of the 6 billion population of the earth, how many Alibabas and Amazons actually get created? The point of me pointing out all these big companies is that reality check is that these people had to overcome so much obstacles, so much difficulty in starting a business to create wealth. But the stock market allows us in such a way that we can actually participate while not taking as much risk as these entrepreneurs. We can actually participate in their creation of wealth. And that's why when we invest in the stock market, it is actually talking about partial ownership, which I'll talk about this and I'll bring it through more clearly later. But first of all, I like to bring out a very obscure person in the investing world. All of us has heard of names like Warren Buffett, Peter Lynch, Robert Kiyosaki. I'm guessing most of you have not heard of this guy called Jeremy Siegel. Now, who is Jeremy Siegel? He's actually a professor at Wharton Business School. Now, Wharton Business School is actually one of the best business schools in the world, in the same ranks as Harvard Business School and London School of Economics. Very interestingly, he came up with an article, and he talked about what is the asset of choice in the long run. What he did was he actually poured through 204 years of research. I repeat, 204 years of research. And what he found was that the stock investor actually earned an average of 6.8% per year after inflation. Now, repeat that, it is actually net of inflation. So if we were to calculate it based on a gross return with inflation, if inflation is at 3%, that means your gross return is 6.8% compounding year after year for the past 204 years if you've invested in the stock market. Now, at the bottom, you see another highlight. It says, this feat is rivaled by no other asset class. So he compared it against bonds, commodities. Commodities, we talk about gold, silver, these common commodities that people talk about. And if we looked at the next graph that I'm going to show you, he actually plotted something very interesting. And it's from his book. It's called Stocks for the Long Run. Now, if you had invested $1 back in 1801, it's right at the bottom left of the chart, in 1801, that $1 has turned into 12.7, I repeat, 12.7 million US dollars in 2001. After 200 over years. Now, equivalently, if you look at the prices of gold, if you had invested $1 in gold and held it over the same period of time, your $1 would have turned into 32.8 US dollars. Now, how many multiples is that as comparatively to stocks? And even bonds, something US Treasury bills, something as stable as that, it can never, this asset class in stocks has no rivals. There's no peers. So, Benny, we're talking about the US and everything, So,
yeah, but I also notice one thing, that they don't have fixed deposits or savings in there.
Yeah, you're absolutely right.
So I guess if they put fixed deposits and savings in there, the chart will be going down?
Yeah, probably, because definitely, actually, not probably, definitely, because of inflation.
Yeah, so what about our stock market then? Because we are talking about the US markets here in the survey, right?
Yes.
What about our Malaysian stock market? Do you see the same growth that we see here on the chart?
Yeah, it's very similar actually. If I refer it to the next slide, this is the FTSE KLCI index. Now, on the left-hand corner of the graph, you won't see the year, but that point actually starts in 1977 when data was actually tracked. Now, all the way till 2017, which is a run of almost 40 years, you will realize that it only goes up in one direction. It only goes in one direction, sorry. It doesn't go in another. Yes, there are bleeps. Yes, there was a financial crisis. If you look at the middle, right at the point before 2000, that was the Asian financial crisis in 1997. It happens to be just a bleep. Over the long run, stocks grow. Why? For a very simple reason is there's increase in population. There's an increase in needs for consumer products, services to serve this increasing population. And businesses actually need to serve this. They grow their business, they grow the economy, the values of the company rise, and the price of the stocks actually rise. So over the long run, as long as businesses and demographics keep growing, this is the trend. And Malaysia is such a young economy, Benny. It's, you know, we've only achieved independence in 1957, all right? The US has gone through all these cycles. They've been an agrarian, agriculture-based economy, moved into an industrial society, moved into the post-war era. They moved into the knowledge-based economy, and now into the Internet 4.0. You know, so Malaysia is just at the beginning. So there's a lot of promise for our country, you know, a young and developing country.
So I guess many people think that, wow, our market has gone up so much, but if we compare to the industrialized nation like the US, I mean, we are talking about, probably the US market is like 50, 60 years ahead of us.
Yeah.
So there's a huge potential growth for the Malaysian market, isn't it?
That's correct. And a lot of times when we look at the Malaysian economy, the perception is that, and you find it anywhere, in analyst reports, in economic reports, that people perceive the Malaysian economy is actually heavily derived from our petroleum exports. While that's true to a certain extent, data actually shows that petroleum consists less than half of the GDP growth for Malaysia. Would you like to would you like to guess what is actually the biggest sector that contributes to the growth of the Malaysian economy?
I guess plantation, isn't it?
Close, but it's actually the semiconductors and electronics sector. We have a very thriving and vibrant sector in electronics and semiconductors, and that actually it's contributing a substantial part to the GDP growth of the nation. You see.
So we have established that the stock investment is probably the best investment platform or asset class that everyone should invest in.
That's right.
For us to actually participate in the growth, isn't it? Because the stock market is actually the backbone for any financial markets of every country. So if you want to participate in Malaysian growth, I think everyone should participate in the stock market. Am I right, John?
Absolutely, absolutely. It is the single most, if you look at all the founders of big companies, what is their net worth or asset actually tied to? The biggest contributor to their net worth. It is actually in the stock market. You look at Alibaba or Amazon, SoftBank, a company based in Japan. One of the biggest coup was actually having a substantial stake in Alibaba. That brought Masayoshi Son multiple times his return, and it's all in stocks. You see?
So we have to make sure that we are actually investing in stocks to get that kind of growth, isn't it?
That's right.
So we have been talking about investing in stocks, but what really are stocks, and what is the stock market actually?
Allow me to digress a bit into history. Now, the stock market, the official accounts of the stock market actually started somewhere in Europe. Now, if you remember in the past, what were the great nations in the world? The great nations in the world were mainly derived from seafaring efforts. Seafaring meaning they were explorers, they were maritime experts, they had expedition vessels to come to what we call the New World, the Americas, Asia, China, India, right? Now, the problem is each of these expeditions were not cheap to fund. And they realized that they needed to pool resources to actually fund these expeditions. So what they did was they said, okay, I have one expedition going to the Far East in China. A lot of investors poured in, let's say 200-300 people actually poured into that investment. The problem was, do these ships have 100% probability of returning to their home country? Not likely, right? They either get hijacked by pirates, or there was non-existent of GPS back then. There's no such thing as satellite phones and things like that. So the likelihood or the probability of these ships returning were very, very slim. And the investors realized they needed to hedge, not just against one expedition, but multiple expeditions. So with this methodology in mind, right, one of the first publicly traded companies in the world is this company called the Dutch East India Company. So it's Dutch, obviously, it's Holland, all right? And they actually publicly traded their expedition to ensure that the public, how the public actually gets a return is that, let's just say I put in 100,000 of my money into an expedition. If the expedition returns, if he's funded 100,000, he funded 2 expeditions, 50,000 each, right? If one expedition doesn't return, at least 50,000 of his investment in the other expedition would hopefully return to him some profit if the expedition returns. So that was the mindset and the thought process that came about to create the stock market. That's why after having this publicly traded company, they realized that they needed to create a proper marketplace to be allowing the public to actually participate in all these businesses that were being created in the new economy.
So these businesses, they need money for their expansion or whatsoever business they have.
That's right.
And instead of looking for their directors or the shareholders of the company, they look for funds from the public, and we as public are able to invest and participate in their growth.
Correct.
So the question will be next, it's like, how are we gonna find a company that has strong growth? But we'll come back into that.
Yeah.
And guys, anyways, if you have any questions at all, please do ask the questions in the questions box that you see on your screen. We will compile those questions later on, and in the last half an hour, we will answer all those questions that you already have. Now, maybe it's talking about the stock market, right? So how do I actually make money by buying this stock?
Very good question, Benny. Let's look at the hypothetical example. If I bought a particular company stock, let's say company A, and I bought this company in the year 2000, right? That's almost 18 years ago. Yeah. So if I bought this company A stock price for $1, and 18 years later, assuming I didn't do anything with it, I just left it there, and it still remains at $1, and assuming the company does not pay dividends, which we'll come to that later, do I actually make money or not? $1 in 2000 and the year 2000 and $1 in 2018. Do I actually make money?
Nope, nothing at all.
Yeah, it's a flat line, you know. So wealth creation from the stock market can be derived from 2 methods. So as we move on to the next slide, the first method is actually wealth generation through what we call capital gains. Now, if you think of it, if you have bought a house for 200,000 ringgit, and 10 years later you sold the house for, let's say, 2 million, 10 times the amount of money, the net difference between 2 million and 200,000, which is 1.8 million, that is considered capital gains. Similarly, in the stock, if you had bought company A at $1 and company A happens to have his share price move to $20, you would have made $19. That's capital gain. The second way you derive wealth from the stock market is actually from dividends. Now, in actual simple concept, what is dividends? Now, if company makes money, how does it share the money or the profit that it makes to its shareholders? The best way is actually through dividend payments. This actually rewards shareholders who are patient in the growth of the company, who want to hold on to the stock in the long run, but do not want to sell. So these guys who do not sell cannot really appreciate capital gain, but they can appreciate dividends from the companies.
So there are 2 ways to make money from buying a stock, isn't it?
That's correct.
Right. So, John, we have been talking about the returns that we have seen earlier on the earlier slides, 6%, 7% kind of returns. But how do we really want to achieve these returns? Am I right?
Yes.
So that will be the key to success in investing. And please hold on with us. We're going to come to that later on.
Yeah.
But we'll address one of the issues in stock investment, and that is risk.
Oh, interesting point.
Right? Because everybody thinks, and if I go around and ask anybody, and if we talk about stock investments, the first thing that comes to mind is, for these people, is that they say the stock market is risky, right? So now I'm going to ask you these questions, right? And we'll see of all the number of people you have here in the audience, and see how many of you think that the stock market is risky. So here we have a poll. I give you 1 minute to answer the poll, and we will take a look at the results in a short while.
Interesting point you brought up, Benny, while they answer the polls.
My parents. I swear
And when they found out, I'm actually a trained engineer. So when they actually found out that I was participating in the stock market, the first warning shot was sounded from my mom and said, "Are you sure you want to participate in the stock market? Because it's really, really risky." And you know, I'm interested to see what's the perception that you guys have on the stock market itself. You know, because I personally have experienced being told by someone I really trust in my family that the stock market is risky.
All right, so let's take a look at the results of the poll. Well, yes, 71% says that the market is risky, and 30% says, well, it's not risky. Wow.
Wow.
So I guess these 30% would have invested and have already made money in the stock market.
That's
and
absolutely
congratulations
correct.
to you.
Congratulations to you.
So if you have answered yes, do not worry, because a study by a local university shows that of the number of people they've interviewed with the same question, 80% actually says that the stock market is risky, and that's one of the reasons why they are not investing. So John, why do you think the majority are not investing in the stock market?
And why do they think it's risky, right?
Yeah.
Now, the thing is, when people participate or when people go into the stock market, there is a very clear distinction in between investing and speculating. Now, if you understand the difference between these two terms, what makes the differentiation is that investors actually have to substantiate the investments decision they make with facts. Whereas people who speculate actually rely or get their sources of information from what we call third-party sources. Now, if you refer to the next slide, and this was actually a very interesting study done by the Asian Institute of Finance. We wanted to find out, and what we gained from this insight was that what were the sources of financial information that most people who participated in the market actually get it from. As you can see from the graph, 65% of them actually rely on their friends, their family, and their co-workers. Now, if you so happen to have an uncle who is an investment banker or who is participated in the financial markets and has made his money, then lucky you. But what about the rest of us? I come from a family of teachers. What do they know about investing? They accept that it's very risky. Now, therein lies the difference. If you rely your sources of information heavily from your family and friends and co-workers, how do they substantiate all these, what I call opinions, with facts? Now, if you scan through the entire graph again, you look at the other sources of information that they look at: the internet, your bank officer, social media, financial advisors, newspapers, and all this. There's one thing missing, Benny. What do you think it is?
I think the source of information itself, isn't it?
Yes. What is a reliable source of information? How do you validate that source? And one reliable source of information are actually the financial statements of companies you invest in. Now, why do I say this is a reliable source of information? For any public listed company, their accounts need to be audited and verified by an independent auditor before it can be published. In order for them to remain listed on the public markets, this has to happen year in, year out. If that fails to happen, the exchange, or in this case, Bursa Malaysia, will take necessary steps to prevent that company from misleading the market. But if you look at the sources of financial information, Benny, there isn't one that mentions about the financial statements of these companies. So therein lies the difference again in between investing and speculating.
So I guess if we don't really understand the markets, then of course we think it's risky, isn't it?
That's correct.
Because later you're going to show us, is the market really risky?
That's correct.
We'll come into that later on. But seriously, we are looking at investors who look at information which are probably like second or third hand information.
Correct.
And we do not know whether this information are based on facts.
That's right.
Right. So I think you have an interesting video to show us, isn't it?
Yeah, that's correct. Those games. Let's cover this thing about facts and opinions again, right? Now, opinions can be formed by anyone, and opinions are something that it can be emotional, or it can be fact-based. Remember the game that we played in school, the telephone game? So you probably have a row of people, right? 10, 20 people. And at the beginning of the row, a message is actually passed. And when that message is passed through these numerous people along the line, right, what happens to the end of the message? At the end, what happens to the message at the end of the line? Now, for those of you who have not played this game, or you've lost track of how this game is played, let's actually look at a video of how this game and the effects of the game, because this is what is happening in our local market, in any markets in the world, not just our local markets. How much time and effort is actually done? Let's just say an uncle or a friend or a co-worker gives you a stock tip. It says this company is doing so and so very well, whatever. How many people actually take the time to verify that fact? How many people actually take the time, or how many people actually know what are the relevant sources where they can take that fact? So let's jump into the video, which will be coming up to your screen very shortly, to see the effects of opinions. Right, so this is the message. Astronauts are not allowed to eat beans before they go into space because passing wind in a spacesuit damages them. So let's see the effect. So the girl whispers into the first guy's ear.
Oh, my baby lollipop, tell you why. It's sweeter than an apple pie. Now when you got the shaky
Astronauts are not allowed to eat beans before they go into space because it might kill them.
See the difference? The original message and the final outcome? What a stark contrast, right?
Isn't it?
Yeah. It's quite a stark contrast.
So that's what happened in stock investment when we rely on this information that's been passed on from one person to another, isn't it?
That's right.
So at the end of the day, we still have to go back to the source. I think the most reliable one is still the source of information. And like you said, it goes back to the financial data or financial statement of the company itself. And probably also look at economic data. So how risky is the stock market? And this is where the value for today's webinar is going to be, because we want to see how we can achieve the kind of returns that we mentioned earlier, gaining about 10%, 11%, or even 15% a year, so that our money can grow faster than our enemy, which is the inflation.
That's correct.
So that we will have enough money later on when we retire, or even if you have started investing, and if we do not have any income, active income from working, we are still able to receive that income that we derive from stock investment to supplement with the loss of income.
That's right.
So we're going to go right to this, but we're going to address the risk part of stock investment, because today we want to convince you that the stock market is not as risky as you think.
Yes.
So John, you have invested for quite some time, and you have prescribed to investing method. Would you want to like to share with us briefly what method do you use to actually invest?
Actually, I practice a methodology called value investing. Now, value investing is this. We actually look for companies that are selling at $1, but no, sorry, the value of the company is at $1, but actually selling at 50 cents. How we want to relate that to actually risk is, if you think of the stock market today, and especially in Malaysia, how will you know whether this is a good company or not?
Okay, so we're going to go into this right now, right? Yeah. How do you identify these kind of companies?
Correct.
And we're going to come back to value investing later on, because John has some other things to share with you about value investing.
Yes.
So, is the market really risky, John?
Before I actually answer that, let's just go back to understand the basic concepts of business. Now, for a business to be good, and the definition good, right? What makes a good company to invest in?
Company makes money?
Definitely. If it's making losses and losses and losses, is definitely not a good company to be investing in. So the earnings of the company is one of the key criteria that makes it a good company. Now, if you think of it, in the Malaysian market, there is roughly about 941 companies as we speak. Or if you round that figure up, close to 1,000 companies listed on the 3 boards in Bursa Malaysia today. So you have the main board, you have the ACE board, and you have the LEAP market. Out of these 1,000 companies, right, we never look at a single year, because a single year of profit could probably be a fluke. You know, you're lucky this year, you may not be lucky the next year.
Yeah, businesses don't make money all the time, isn't
exactly. It? But what you want to look for is the longevity or the sustainability of these companies making money. So what I'm going to ask next is something very, very insightful. Out of these 1,000 companies in Malaysia, how much or what is the percentage of these companies, 1,000 companies, continuously, the key word I'm referring to is continuous, continuously making profit over the past 10 years. Now, if you think back, right, we are in 2018, but a lot of them have gone through or reports the financial year end is December 2017. So the reports for 2018 has not come out. But if we look back 10 years, what did these 10 years entail? It was the subprime crisis in 2008, right? The global financial crisis. So these companies had to go through the global financial crisis in 2008. And out of these 1,000 companies, what is the percentage of companies that continuously, without fail, make net profit for the past 10 years?
So now, that will bring us to the next poll, isn't it?
That's right.
For you guys to answer the question. So what is your thinking or your thoughts about how many percentage of companies in Bursa Malaysia, we are talking about 1,000 companies, and how many percent of them has actually made continuously net profits, I'm talking about net profits,
Not
right?
profits, that's right.
For 10 years consecutively. So please participate in this poll, and we'll take a look at the results, because the results may shock you.
Yeah. So if you say 10%, that means it's close to 100 companies, just for a simple mathematical estimation. So looking forward to your participation in polls.
Can't expect me to be fine. I don't expect you to care. I know I said it before, but all of our bridges burned down. I wasted my nights. You turned out.
Guys, if you still have questions, please keep those questions coming in. You can ask those questions at any point of time. We will compile these questions and we bring them up in the last half an hour of this webinar. So I guess this is enough time, isn't it, for them to answer the question. So now let's just take a look at the results and see how many percent do you think that companies making continuous profits?
Oh, that's pretty interesting. Quite well spread out, Benny.
So the majority still thinks 5%, 25% says 10%, 20%. It's quite well spread out, isn't it? And 40%. There's 9% thinking that it's 40%. Well, that's interesting.
That's interesting.
I guess these guys are the ones that are looking at financial data, isn't it?
That's correct.
But most of them are probably rely on information that's been passed on, like those information from family members or from reports, from news and whatsoever.
Correct. Correct. So the majority of you answered that only 5% of companies have continuously made profit over the past 10 years. Now, let's actually run through what we call a screener. Now, what the screener actually does is we will try to filter out of these 1,000 or close to 1,000 companies in Malaysia, we set in a criteria that these companies that pass through the filter has to continuously make profit for the past 10 years. So let's give an example. Let's just say 2007 they were profitable. 2008 they were not profitable. 2009 profitable. 2010 they were not profitable. This company that I just gave an example would not actually show on the screener. So let's go through the screener. I'm going to show you on my screen right now.
And this screener is based on real financial data.
That's correct. Financial statements and earnings that have been taken and curated and put into a database. So I'm going to key in annual net profit, a minimum of 10 years. That means for the past 10 years, minimum they have to actually make net profit. And I leave the maximum as at the default value, which is 99 years. And let's see the results. Now, for those of you who said 5%, so 5% out of 1,000 would roughly be 50. 50 companies, that's right. Let's scroll down the list. Let's scroll down the list. And whoops, I'm already at 50, Benny. I'm already at 50. Let's scroll down some more. For those of you who said 10%, you're talking about 100 companies, right?
100 companies, yeah.
And I'm only at C or D. So at D, I'm already at 100. Or G, sorry. At G, I'm already at 100.
So it looks like there's more, isn't it?
There's definitely more. If I remember correctly, there are 26 characters in the alphabet, right? So let's scroll down the list. For those of you who said 20%, 20% would actually be about 200 companies. So let's see, let's stop at it. Let's go to 200. Wow, interesting, huh? 200 companies, Benny. So
and there's still more.
And there's still some more, and we're only at P. So let's scroll all the way to the end of the list. For those guys who actually said 30% and 40%, it doesn't seem too far-fetched, by the way. So I'm guessing most of these guys who actually came up with the 30-40%, either could have been a very educated guess, or you guys really rely on valid, reliable financial data, right? So in total, 305 companies, Benny. 30%.
So that's 30%.
30%. Shall we print this list out as a door gift to all the participants today?
Yeah, why not?
So now, let's go back to the presentation matter at hand.
So we all talk about earnings, right?
Yes.
And about 300 companies that have net profit year after year for the past 10 years. But not all companies pay their investors the dividends.
Correct. And Benny brought up a very good point now. As a business, earnings is actually retained within the company. Meaning that all the time, whenever a company makes net profit, the earnings is kept within the company itself. Now, the struggle is, how do investors actually receive or take profit without selling ownership of their shares in these companies? It's actually through dividends. Dividends actually also show one thing: the majority shareholder alignment with the minority. How fair are they to you as a minority shareholder of the company? Now, we saw, as the screener showed us, 30% of these companies continuously make profit for the past 10 years. How many percent do you think these companies continuously make money or make a net profit and continuously pay you a dividend?
Year after year for 10 years.
Year after year for 10 years. So it's an even, is it a more lax criteria, or is it a more stringent criteria?
It looks like it's a bit more stringent, isn't it?
It's definitely more stringent, because they have to make money and also they have to pay you a dividend. So let's go through the screener again. Now, the first criteria was net profit. So minimum of 10 years. Now for dividends alone, let's key in a minimum criteria that it has to be 10 years as well. Right? Let's run through the results and see. So if we scroll down the list, let's look at 10%. So 10% would be 100 companies, right? If we scroll down the list, okay, we're at 100. And 100, we're only at K. Interesting, huh? And if we scroll down the list further, what do we see? Scroll down the list all the way to the bottom. How many companies are there that continuously make profit and continuously pay dividends? What's the number? 228.
Well, that's still a good 20%.
That's a good 20% of the market that continuously make money and continuously pay their shareholders dividend. Isn't that a vibrant market for you, Benny?
Well, 20% is quite good, isn't it?
Exactly.
Because there are actually 200 over companies there that is worth investing.
That's correct. That's correct. Do bear in mind, though, this is not a shopping list that you go and park all your trades tomorrow for these 228 companies, all right?
Because there's still one more thing they want to share with us, isn't it? Which is the basis for value investing.
That is correct. That is correct. Now, as Benny rightly mentioned, why people don't actually invest in the markets is because they think it's risky. Now, the difference is this, right? If you go on to the next slide, the real reason why people don't invest is just lack of understanding, lack of knowledge of the market, don't know where to start, or a very likely scenario, overwhelmed by the information that they have, that they cannot separate noise versus fact. So that's where, as I explained earlier, the difference between investing and speculation. I like to borrow a quote from this guy called Edward Deming. Edward Deming actually mentioned this quote that lives with me for life. He said, "In God we trust, whatever God that you believe in, be it the Muslim faith, Christianity, or Buddhism, or whatever. But all others must actually bring data." Now, what was the impact of the message he's trying to say? Everybody is entitled to their opinion. Everybody is entitled to whatever stories that they can cook up. But can it be substantiated with data to make it a fact? And then I will actually move on to the methodology of investing that we apply.
So we have that 200 over companies there, right? And you said there's not a shopping list for every one of you to get in, because you still need to understand further on how to even go further into finding the right company out of the 200 over companies.
That's right.
And I think John has something to share with us using the value investing principles.
Yeah. So as you were rightly asking me earlier, what was the methodology I employed? And maybe I do give some brief background of this concept called value investing. Now, if you think of it, right, what you want to do when you go shopping, what is the best period for you to go shopping?
During sales.
During sales. And why do you do that? It's because you know that a particular product or merchandise is selling, let's say, at $100, and during the sale period, you get it at $50. That's correct? Now, similarly, value investing practices this methodology. If we like to simplify value investing into a very simple graph, which we'll show in the next slide, this graph actually shows what does value investing actually mean. Now, look at it. The x-axis is and the y-axis is actually price. So you see the fluctuations of the price. Now, what value investors look for is what we call a price, which is the red line, versus the value, and we look for this thing called a price value divergence. Now, what does this actually mean? Let's paint an analogy or an example. If you look at the next slide, we look at real estate, something very tangible to a lot of Malaysians.
I think yes, everyone understands.
Real estate, right?
Yeah, house prices.
House prices. Now, this is Jalan Telawi. For those of you who are not from KL, this is from an area called Bursa, one of the most expensive places to live in KL, besides Bukit Damansara. So this is a terrace double-story house. Probably developer's price, the guy would have gotten it for like 300,000-400,000. What is the market price of this corner terrace house today? What is the market price? So the market price of this lot is actually 2.85 million ringgit. 2.85 million ringgit. Now, what if I told you, Benny, that the market price suddenly fell to 800,000 or 850,000?
Well, I'll immediately go and sign up for the house.
You immediately go and sign up for the house, right?
That provided that the house is still okay.
Yeah, the house, as long as the house is not haunted, as long as there's no sinkhole near the house, you will definitely buy it, right? Because
Yes.
you know the locality of this house is perfect, right? Now, how do you determine value? So how do you do this? Is an easy example based on real estate. But how do you determine value based on the stock?
A stock.
Yeah. So we're having some technical difficulties. I understand some of you are not getting any audio. So right. So we're going to change the batteries for the mic. Just bear with us for a second. Right, I hope you guys can hear me better. Okay, so I'll just quickly repeat what I explained about the real estate. So market value today, 2.85. Price dropped to 850,000. Benny says he will rush to buy this property. What about the stock market? Is there a similar comparison that we can do, Benny?
Let's take a look at the example that we have provided.
Yeah. Let's take a look at the example that we've provided. Now, if you were to look at the next slide, now this is actually a company that has a tagline called "Everybody Can Fly." Asia, one of Malaysia's best known brands, right? Best known brands. Now, don't worry about the table on the top first. Let's look at the graph at the bottom. Let's look at the graph at the bottom. Now, if you see the first circle, which is on your left, in the year 2010, the price of Asia was 2 ringgit 60 cents. 2 ringgit 60 cents. What happened 5 years later, Benny?
Oh, the price went down 50%.
Yeah, the price actually went down 50% to 1 ringgit 30 cents. 50%.
So it gives me an impression that the stock is not doing well, isn't it? The company is not doing well.
Yeah, so it gives the impression because of the deduction in price or the reduction in price, the company's business is not doing well. But is that a fact, Benny?
Well, that's market opinion, isn't it? Because the price charts on the market, the price that's being transacted in the market is basically opinions. So most of the people think that the company Asia is not good, and they were selling, and price came down. But it's probably not based on facts. I do not know until we really look at the facts.
That's absolutely right, Benny. So if I can take your attention to the table above. Now, this table is a very simplified table of Asia's profit and loss statement. For those of you who want to understand more deeply, come to our A1 class. It's a face-to-face class organized by Bursa. We will be covering this in quite some detail to help you understand financial statements better. So coming back to the table that we mentioned, in 2010, Asia's revenue, or what we term simply as sales, meaning how much seats do they sell. Asia is an airline business, right? Their business is derived from selling seats on planes so people can fly. Now in 2010, their sales was 3.9 billion Malaysian ringgit. 5 years later, if you scroll towards your left, from right to left, in 2015, what was their sales, Benny? If you can read it out loud for us.
Well, 2015, the sales is 6.9 billion.
Yeah, so 6.9 billion, you're talking about almost a two times increase in sales. But what actually happened to the price?
So actually, the value of the company has gone up because the sales has increased, isn't it? But why is there a price decline?
Yeah, so sales has gone up, but price has declined by 50%.
So this is what you meant by there's a divergence between the value and the price, am I right?
That's precisely my point. We are looking for companies that have grown in value, but come down in price. And this is a very easy and clear example how a price and value divergence exists in the stock market. So I've given you two analogies, one for the real estate market and one more for the stock market.
So if I have this information, then I will have an advantage against the other investors, isn't it, who doesn't have this information at all.
That's precisely the point, Benny. That's the reason why investor education is key, because let's put out the fact. How many people are actually trained to read financial statements? How many people, even with accountancy background, knows how to read financial statements from an investor's point of view, but not an accountant's point of view?
So what happens if I buy Asia in 2015?
That's an interesting question. Let's look at the next slide. Finally, we get our mics back. Sorry for the apologies for the slight technical error. Right. So, looking at the next slide, as Benny mentioned, if you had participated into a partial ownership of AirAsia, almost at the bottom in 2015, when sales has actually grown 2 times, what happened after that, Benny?
Wow. That's 120% increase, and that's not even a year, isn't it?
That's not even a year. It's 120% increase from a 130 to 290. So can you imagine if you know and you had the skill sets to read financial statements such as this, wouldn't you have an advantage in the market? Is the market really that risky?
Well, I think if we have that information, then it will not be as risky as we think, isn't it?
That is absolutely right. People only have an advantage if they know what they're doing.
So, I guess if we have applied this strategy in the long term, we could achieve the returns that we are expecting, that 10%, that 15%. And you know, value investing, as Warren Buffett, he is like the legendary investor that everybody knows, right? And he's making like 21% a year.
That's correct. Buffett, in his early days, he used to make 40% compounding. And because of the size of his fund today, he's swimming in cash. This year, his holding company called Berkshire Hathaway, they will have 100 billion in cash. He's swimming in cash. The struggle for people with that kind of size of a fund is trying to generate the same kind of returns as retail investors like us. But even then, he's still doing 20% a year. So I guess the next question we should be asking all of us is, how do you determine value? If you refer to the next slide, how do you determine value? And I like to quote the Sifu, the guru of Warren Buffett. So Benjamin Graham, he used to teach value investing as a Master's of Business Administration course in Columbia University in the 1930s. So he made this very interesting quote. He said, in the short term, the stock market is a voting machine. But in the long run, the stock market is a weighing machine. What did he actually meant by that? The problem with the market today is that people don't understand or take time to understand the real value of companies. And it takes patience, it takes understanding market emotions, and it takes a skill set to filter all this noise to be able to see value in the long run. It's a patient game. Value investing is, the analogy we will say is, it's like watching paint dry, You know how boring, you paint and you watch the paint dry. It takes patience, right? So in the long run, it is really a weighing machine for those who understand value, you see.
Yeah, so Warren Buffett was not famous 30, 40 years ago, right?
Definitely not. His fame only came about when he started. He only turned to become a billionaire at the age of 57. So, there's still hope, for those guys who feel that there's almost at the end of the runway. I beg to differ. I think the best time to plant a tree, as Warren Buffett said, was 20 years ago. The next best time is actually now. So equip yourself. Start equipping yourself. It's never too late.
Yeah, but I guess it's not just Warren Buffett. There are a lot of other investors who are able to gain returns like even 30, 40, even 50% returns in a year.
Yeah,
right?
That's right.
So we are looking at price and value. I remember Warren Buffett once says that price is what you pay and value is what you get. So we have to basically make sure that when we pay for a particular counter or when we buy a share, we make sure that the value is higher than what we pay. That's it, isn't it?
That's a very important point too, Benny, and I'd like to elaborate more. Now, a lot of people always associate price of a particular stock or a company to the value of that company. That couldn't be further from the truth. That's why Warren Buffett always believes that because of these market inefficiencies, there will be times when there is a price and value divergence. And this is where value investors sweep in to take opportunity of this divergence to profit from the market, actually.
So it looks like, for probably a new guy who wants to invest in the stock market, it looks like a bit difficult, isn't it, understanding value and price and talk about earnings and so on and so forth. But you've mentioned that value investing is easy and is stress-free. And now, can you elaborate that further?
Sure. I like to use an example of a horse. Now, everyone knows a horse. Is horse riding actually easy if you do it yourself? Now, if you look at the picture in the slides right now, this is a jockey, a race jockey. They have to ride really fast to win the race. Now, for him to be a race jockey, it takes effort, it takes training, it takes a lot of stamina to be able to ride the horse as efficiently, as fast as possible to win the race. You bring that analogy to businesses. If you want to create wealth by starting your own business, is it an easy task to do? Alibaba, when they started off 10 years ago, nobody heard of him. Nobody actually, not many people understood the struggles that Jack Ma had to go through to actually bring Alibaba to where it is today. It took him 10 years to bring Alibaba to where it is today. It is not for the faint-hearted. So if you think that creating wealth from starting your own business is easy, I really like you to think again. Now, the question that Benny asked was, is value investing that difficult? Similarly to the horse analogy, you think of investing as you sitting on a carriage of a horse. You understand where the horse is going. You have faith in the person bringing or steering the carriage, and you trust him to run your business. However, you partake in some risk by investing in a partial ownership in these companies. That's how I would like to simply describe value investing. Rather than doing it or riding the horse on yourself, you find a horse carriage that's already being ridden by someone. The horse rider, or the carriageman in this case, is actually the person steering the business. You pay him some money for ownership of sitting into this carriage, and you enjoy the ride of the business growth. That's what value investing really is. It's really stress-free.
Okay, so John, you have already given a few keys, right, to your principles of investing. You look for companies that has good earnings, that pay dividends year after year, consistently, and we are looking at about 200 companies in the Malaysian stock market. And we also talk about price and value divergence. We probably want to buy these stocks when the price has gone below its value.
That's correct.
Right? And I think you still have something to share with us, isn't it? And that will sum up today's key to success in stock investment, because if you do not have the key to success in stock investment, you will not be able to unlock the potential in the stock market. So if we use speculation, the speculation key, now it don't work, we can just throw away the key, it doesn't work. And if you use another information, which is news, maybe you look at news and this key don't work as well, so better throw it out. And if you look at the tips and rubrics that you get from your family members or friends, you do it, and time after time, people have failed in investing. So it doesn't open a lock. But you know what? John has a key, isn't it? And he's going to give us the ang pao. And one more special principle or criteria that you can bring home so that you can sum up today's webinar, and you can get this ang pao. Ang pao, you're going to give it to me right now?
Yeah, it's Chinese New Year season, so spirit of giving, ang pao to you.
So let's say this one more key is able to help us to unlock the potential of making good profits in the stock market, and that is the principle of value investing, isn't it?
That's right.
So let me just try to open this lock, and if it does open, John, you will have to share with us. Now, take a look at this. There you go. It's open. So John, you have to share with us now.
So in the spirit of giving, and it's in the season of Chinese New Year, let's look at what are the 3 important criteria that you should basically start with. Now, the first criteria is actually a very qualitative criteria. It's not a quantitative criteria. How well do you understand the business? A simple example. Benny, did you drink Milo growing up?
Oh yes, I still drink.
You still drink it, right? I still drink it. What was your favorite food as a teenager? Was it instant noodles?
Oh yes, Maggi Mee is one.
Maggi Mee, right? How long has these staple brands been around our Malaysian society?
I guess when we were babies.
Oh, babies, right? And does understanding, or does it take a lot of effort to understand a business like that? Selling noodles, selling instant noodles, selling beverages, selling cereals. Is it a very difficult business to understand?
No, it's quite simple, isn't it?
It's
Because
quite
everybody
simple.
uses them, everybody consumes them.
Correct, correct. And that's one of the reasons why this first criteria is key, is because one thing that Buffett doesn't like to invest in is investing outside of his circle of competence. Now, you know, if most of you have read about Buffett, one of his best friends is actually Bill Gates, the founder of Microsoft. So Bill Gates actually tried to introduce him to tech, and he just says, don't worry, you stick with your tech or technology, I stick to my chewing gum. Because he was an investor of Wrigley's chewing gum. Something very simple, you know, it doesn't take a lot of effort to understand the business model they're in. Now, the second criteria that we should be looking at is, do they make money? Obviously, right? If they don't make money, how can they be in business for the long run? So as we shown using a filter earlier, do you have the right screening tools, or are you using the right methodology and the right data set to find out whether these companies have continuous earning? The keyword is continuous, because certainty of years gives you certainty of return. Last but not least, if the company makes money, how are you as an investor participating in that growth in the profit? It's actually dividends. Does the business continuously pay dividends to its shareholders? It must meet at least these three basic criteria to be able to fulfill the homework that you need to do to understand before you buy this company.
Well, there you go. And this is what I've learned, John, right? When applying the value investing principle. So first of all, we need to have companies that has continuous earnings, profits. Right. They pays dividends continuously. And based on the filter or the screener that you have gone through, we have 200 counters in Bursa Malaysia that you can has met the criteria.
That's correct.
So all we need to do now is to look at that 200 companies and find a company that we understand.
That's right.
All right, that will be the first point that you have mentioned earlier.
Correct.
And the best timing will probably be when there is a price and value divergence.
That
so
is
there you
right.
go, guys. This is the ang pao that we have for you, and that's the key to success in stock investing.
Yeah.
Now, John, I'll come back to you in a short while, but you know, there's another problem that most investors face, especially the younger ones, the millennials.
Oh yeah, the millennials.
And that is not having enough money to invest, right? But the question really is, do you really have no money to invest? Let me ask you this question.
Yeah.
Right? If you are a young person, do you own an iPhone? Or do you own a Samsung? Why not a Xiaomi from China? Okay. Do you own a branded shirt or pants or shoes? Or do you own a very expensive car? Now, if we could save money from all this money that we have spent on these items, you will have some savings. Am I right, John?
That's correct.
But that, of course, requires some sacrifice, because, you know, in Malaysia, we have one problem, and that is the Gaya Mesti Ada problem.
Gaya Mesti Ada,
right?
number one.
We have to look good all the time, and we want to impress people, and that's the reason why most people get into debts.
Yes.
So I think the key word here is discipline. If, let's say, this particular year, I do not buy a new handphone, if it's still working,
Yep.
I do not buy a new laptop to impress my girlfriend, my wife. I don't have a girlfriend, I already have a wife. I do not buy a new car because I still have the car.
Yeah.
You know, instead I use that money that I have saved from buying these items and buy companies.
That's right. Partial ownership of companies.
So when I go around, I can tell people that, you know what, I own Maxis, you know, I own Petronas, so I own Air Asia, as a matter of fact.
Yeah.
So really, do you think that you do not have enough money? Think harder. So that's that's the advice that I want to give to the young ones, especially.
Why
because
don't we take a poll? Why don't we ask the audience?
yeah, I think that's a good idea. So let's take a look at what do you think? Do you have enough money to invest? So that will be the last poll of for today. And let's take a look at, after me explaining to you whether you have enough money or not, and let's see whether you really have enough money to invest.
That's interesting. I would like to see, because I think we have quite a wide demographics for audience today. We've got those guys in your millennials, the millennials, and probably some very senior investors. So let's look at the results of this poll.
All right.
Oh, okay. Apparently, if you think of it, people in Malaysia actually have a lot of money. Why do I form that opinion? Is this? It's substantiated by fact, like what I've been preaching. You look at all the scandals of money games that have happened most recently.
Oh, that's a lot of money.
That's a lot of money. JJPTR, one of the more famous ones, they managed to swindle 500 million US dollars, or equivalent of 1.5 billion Malaysian ringgit of the Malaysian public's money. What about the most recent forex schemes in Penang? They managed to swindle 1 billion of Malaysian public money. And yet, people find the stock market risky. I find it pretty perplexing, you know, because people say they don't have money, and yet all this money is being poured into all these schemes, you see. So is it really because they don't have money?
Well, I think there is enough money. It's just that the money has gone to wrong purposes.
Yeah, or wrong methodologies.
All right, so let's take a look at the results of the poll. Wow, 50-50. So it's about the same, isn't it?
It's about the same, yeah.
Yeah, I think some of you think that yes, you have enough money to invest. Some still says no. But then again, think harder, right? You always have enough money. It's just that where do you put your priority on your money?
I think the key word that probably would sum it all up is actually called delayed gratification. Now, if you think of it, how many of you upon your first job spent it on a car or spent it on some luxury that you could probably have delayed it by 1 or 2 years. Now, all this is key is because what you want to benefit from is the benefit of time. And only time can help you realize the compounding effect of wealth creation. If you don't allow time, if you don't start early, how can you allow time to help you compound your money? By just taking a few by first taking a few key steps in the early part of your journey towards financial freedom makes a big and monumental influence or results in a very big change in your financial independence upon retirement. So there you go. I think we've come to the end of the webinar.
Keep those questions coming in because we're going to spend the rest of the other half an hour to answer the questions that you have posted. So before we go into that, John, any last advice that you want to give to the audience here?
Yeah, this is actually a very, thank you for reminding me, Benny. Actually, let's just say this year you start a resolution that you want to start investing. So what would be the best investment that you should start with? Now, let's go to the best of the best, Warren Buffett. He says that this investment supersedes any investment that he's made in his entire life. Be it the Walmart, be it Bank of America, be it, what is this famous, Apple. Most recently, he bought Apple. He said that this investment supersedes all of this. And want to know what it is? It is actually investing in yourself. That investment supersedes or triumphs over all other investments that you can make from now on. Why is that? It's because once you invest in yourself, can anybody take away whatever you've gained? Whatever skill sets that you have attained, whatever knowledge that you've attained, nobody can take that away. And when you have those skill sets and those knowledge, the advantage that it brings you into investments will be key to making sure whether you are successful or you will fail. So the best investment is yourself. Attend seminars, buy books to read, get substantiated information from reliable sources such as financial statements, not based on opinions, not based on hearsay, or not based on third-party unreliable sources. That's key.
Oh, fantastic, John. But you know what? We have good news for the audience because Bursa Malaysia has already answered 50% of your problems here. In its effort to actually educate investors, Bursa Malaysia has come out with a series of webinars like this and also face-to-face seminars to a city near you. So all you need to do is to spend time to attend these workshops, so that at the end of the year, you'll probably be a well-informed investor and a smarter investor, and so that your money will grow like Warren Buffett.
Yeah.
So since that you have already registered for this webinar, we will email you the details. We will have a few workshops coming up this month and also the coming months. So please do check your emails so that you are able to attend this workshop brought to you at a very minimal cost and even free by Bursa Malaysia.
Yeah. So probably we want to look at the questions, Benny.
Let's go to the questions. Now, let me just go into my laptop and take a look at the questions. Now, first question here, John. Oh, this guy asked about intrinsic value. So I guess he is a little bit more educated. The question is, how do we predict a company's intrinsic value?
Okay, the key word that he mentioned is predict. Now, intrinsic value, if you have read any of Buffett's books, he keeps on mentioning intrinsic value, but has any formula been given about intrinsic value? Now, the reason why I ask this question back is this. How can you use a certain metrics or a certain methodology across all businesses in different industries? Can you benchmark a company like Nestle that manufactures beverages against against another company like, for example, Padini that makes clothes or apparels? It's a different way of making or finding intrinsic value for these two different companies. There is no one secret formula to determine what is intrinsic value. It is always the case of understanding the business, understanding the industry it is in, and making both a qualitative, I repeat, a qualitative and a quantitative analysis of what this company can actually be valued at.
So that was the three keys that you have given to them earlier, isn't it? We still
Coming
go
back
back to the main principles in value investing.
Correct. And I like to put in this phrase. It's actually very, very powerful because it says, you can never over-drill the basics. Everyone is looking for that secret formula, that complex formula. If I plug the numbers in, I get an intrinsic value of a company. Well, guess what? It is not that straightforward, but it always goes back to basic. How well do you understand the business?
Well, the next question will be a little bit more technical because he's asking about where do we get the financial reports, because you have been showing us the screener and so on and so forth. So where do we get this information?
Very good question. The most reliable source is actually from Bursa Malaysia itself. Now, every year, all public listed companies are mandated to actually publish what we call the annual report. On top of producing the annual report, they are also mandated to produce what we call quarterly earnings or quarterly reports. All this is readily available on Bursa Malaysia's website. The struggle is, how do you take all this information? Because annual reports are year by year. So how do you take this information, curate it? Curate, meaning you think of Google, what businesses are they in? They're actually in the business of curating information. So how do you want to curate all these separate annual reports into a very easy and a very readable format for you to make your analysis? You can start with the free ones that are already available: Google Finance, Yahoo Finance,
Even Bursa Marketplace.
even Bursa Marketplace, or even Bloomberg. Bloomberg actually does provide free data to the public, but it's very limited in nature. So that's the first line of information that you can get, curated information. The second level is actually looking at paid services that actually spend the time and effort to take, curate, and to filter out all this information that is making it easily readable to investors. I hope I answered that quite extensively already.
Yeah, so next question. The next question will be, what steps do we need before purchasing a stock? And John, if I may, because I've learned from you today, let me answer this question.
Please do.
I think we have already given you the key to success in stock investments earlier on. And I think maybe you've asked this question earlier, right? So remember the steps? We look for a company that provides good earnings year after year, consistently. Second one is that it pays good dividends year after year, consistently. And out of that 200 work counters in Bursa Malaysia, I would want to identify company that I understand. So if I see, let's say, Nestle is in the list, I'll probably go for Nestle, isn't it?
Yeah,
And
simple
that's
to
me.
understand.
It's up to you.
Yeah.
And of course, the last one will be looking at the price and value divergence. I will be looking at the price of the company. If it goes below value, that's when I'm going to buy it.
That's correct.
Is that correct, Don?
Precisely on the dot.
All right. So I answered that question. Next question. How much dividend should a company pay to be considered good?
Haha, that's a very good and tricky question, actually. Now, I like to use the example of a growing business. If a company just got listed and they wanted to grow their company, right? They want to grow sales. Do they need to spend money? Most definitely, right? They have to either set up new branches, build new plants, buy new machinery, or buy new software to be able to grow the business. So if you link that back to dividends, right? If a company is still trying to grow its business, do you think it is fair, or do you think it is a sustainable practice to be getting those companies in the growth phase to be paying you 100% or whatever they make? If they are doing that, right, they are stifling or preventing the growth of this company to the next phase. There is no magic figure to what is the percentage of dividends you pay. But what we actually look for as value investors is we should look for a particular yield. Would 3%, 2% be enough for a company that has already reached maturity? Meaning, for the first few years, they don't pay you dividend. They really spend money to grow the business. They pay you 0 dividends. But as it matures, as it comes to maturity and they have reached stability, wouldn't 2-3% be pretty good? Because if you compare that to fixed deposits, that's actually sometimes substantially more before Bank Negara actually increased the interest rate. So there is no magic formula. It all depends on the phase of where the company is. And it all depends on whether they have sustainability to pay the dividend. What's the point of a company paying you 100% of its net profit in dividends this year? But that can't sustain, and next year they don't have money to grow the business. You see?
Yeah, and company do grow, isn't it? Because the dividends that they're paying now may be smaller than in the future. If the company grows, they probably pay more dividends.
That's correct.
So that would not be a really good indicator to look at.
Correct.
So now, if I have no time reading or sourcing information for myself, and have to rely friends and family, or friends and family again, John, what can I do? That's the next question.
Make sure your friends and family back it up with facts.
Yeah, if they don't back it up, I think you have to back it up with the facts yourself.
Correct. So, put it this way. You heard of this phrase, right? The blind leading the blind. It's not going to bring you anywhere. But you make sure that if you rely on information, make sure it's verifiable by fact. Make sure it is something that is sustainable and not purely an opinion. Now, let's be very truthful about the factor. By being a value investor, it is somewhat mandated that you have to read. There is no escaping. There is no free lunch in this world, and it is not easy to look for price and value divergence if you purely rely on friends and families that also don't do their homework. Unless you're very lucky, you happen to have an uncle who practices in value investing. He does all the work and you just participate in whatever he does. But make sure it's not the blind leading the blind again.
So next question, I think is probably from a new person who just started investing. Should a new investor focus on capital gains or dividends?
Very good question. I think I would rather answer that by asking another question. What is your time horizon for investing? Only by answering that, then you can clearly understand the difference between why do you need to focus on capital gains and dividends. Investing is always long-term. And if you focus so much on dividends, that means that this particular company, as I answered the earlier question, has already reached a phase where growth will not be substantial or phenomenal. These companies that have already reached financial equilibrium, cash strong and everything, you're not going to expect it to perform 20, 30, 40% kind of growth in a year. because they have reached that kind of financial stability to be able to pay you dividends. So if you focus on dividends, then what are you missing out? You're missing out on companies that are in their growth phase, but do need a number of years to be able to grow the business to attractive valuation. So once you get the time horizon right, then the answer to your question of whether you should focus on capital gains or dividends will become clearer to you.
So next question, how do we control risk when we invest in the long terms? Do we put stop losses in investing?
Stop losses are mainly used by traders. The reason why stop losses and all are put in, and this is purely my personal opinion, is because they rely heavily on the movement of prices. If you understand a business and you have gotten the time horizon of investment correct, which is long term, do you think that a company like Nestle will change its business model or will decline in business year on year? No, right? They have been producing Milo for the past 30, 40, 50, probably even 50 years. Is that business model going to change? Is that something sustainable in the long run? That is why the first key to the 3 key criteria I gave you was understanding the business. By having all these stop losses and everything, people get fixated too much on the price, but forget about the long-term value of a business.
Well, just let me put some points here, John.
Yeah,
I think you know, we often heard about stop losses. You know,
Yeah.
I guess they've mentioned earlier, stop losses are normally employed by traders.
That's correct.
And you have to remember that traders' objective is not the dividends, but capital gains.
That's correct.
So if they are wrong, they have to get out and find another opportunity elsewhere.
That's correct.
So value investing is totally the opposite, because value investing aims at both capital gains and also
And dividends. That's correct.
Right. So we move on to the next question. If I have money, right, do I invest or should I save it?
I'll give an analogy that I normally give in my value investing class. What is the interest rate of saving accounts today? 0.2%. Let's not talk about fixed D first, just for simplicity's sake. So 0.2% in a savings account, if I put 100 ringgit into that account, what is the amount I get at the end of the year? 20 cents. 20 cents. Is that something that can sustainably create or generate wealth in the long run? Definitely not. What is the next alternative to savings? Fixed deposits, right? Fixed deposits is actually considered a savings, not an investment to me. Why is that? It's very simple. Does the interest rate of fixed deposits exceed those of inflation?
Well, I guess not.
Definitely not, right? So what happens if you keep your money in savings? Yes, you fear the risk of losing that money in the stock market. But are you doing credit to the money that you're putting into fixed deposits? The purchasing power of money being kept in savings and fixed deposits will erode over time. And by 10 years from now, at the inflation rate that we're looking at, you probably halve the purchasing power in time to come. That's why you need to invest. Because by you taking a small risk, I'm not saying a very big risk, a small risk, you can actually gain a return that is exceeding that of inflation. That's the whole reason why people invest.
Right. So the next question is probably one who have invested before. Now, he says here that company financial reports are not forward-looking. Therefore, we have to rely on news or forecasts. How do retailers, which means people like you and I, get the correct source of information?
Understanding industry trends. Reading or understanding economic data. While they may not be a good indication or forecast of what this company will do, but at least it gives you a horizon of where this company will perform. I give a very simple example. If we rely on forecasts of one particular company based on news, and we look at Nokia, we all know about Nokia, right? Nokia at the peak of its days, I'm very sure a lot of analysts were writing about how big it will grow, how they will dominate the world and everything.
Yeah, I don't think so. It will go past, isn't it?
Yeah,
Because,
exactly at that point of time. So if you rely on market forecasts, but you forgot about consumer behavior change and understanding industry trends, this is where the fallacy of having your faith so much in forecasts defeats the purpose of investing. Because remember the key point that I mentioned, Benny? Understanding the business. Understanding the business also understands the economic model of this business going forward in relation to the change in consumer behavior. If I see today Tesla having a electric car, and nations around the world are actually going or are enacting laws to prevent gasoline cars from the road, then what does this spell? I give a very good example, context based. Sooner or later, gasoline engines will be phased out. But if we have our faith in buying companies like Toyota and all these other car manufacturers, we are actually turning a blind eye to the change in consumer behavior, the change in these trends. That's where, rather than look at business forecasts on the news, look for reliable economic and industry trend reports and articles.
so it all boils down back again, the news and reports are basically opinions, isn't it?
That's correct.
And we always have to go back and look at the facts again.
Correct. Maybe just as a bonus to this person who's asking the question, the World Bank, IMF, even United Nations, if you read carefully to their reports, their global reports, or the World Economic Forum, Davos, if you read at the reports that these guys actually generate after each of these conventions, it actually gives you an insight to the changing of consumer behavior, the changing of industry trends. That is something that you would have a better reliable forecast rather than just reading on analyst forecast.
So if I have money to invest, should I put my money into someone who manages for me, like a unit trust, or should I do it myself?
Very interesting and very debatable question. A lot of times people put their faith in people who they think know better than them. However, this very famous fund manager called Peter Lynch, he actually believes that the best fund managers are actually the people who own the money themselves. He believes that these people will be nimble, will understand consumer trends much better than the fund managers. The disadvantage of putting into a pool fund is this, Benny, and let's try to understand a bit of the fund structure. If you invest money into unit trust, right, what are you actually doing? What is the methodology of investing in a unit trust? Your money, someone else's money, and someone else's money gets invested in what we call a pool fund. A pool fund. All money is lumped into one fund. Now, during a financial crisis, for those investors who are not financially or investment savvy, what do they normally do, Benny, during a market crash?
They just sell.
They want to redeem the money, right? They want to redeem the money. But during a point where there's a market crash, what will actually happen is a lot of companies will undergo what we call price value divergence. Is that the best time to buy for fund managers or the best time to sell? It's the best time to...
If you look at really, if there's a price and value
divergence, it's the best time to buy, right?
Yes.
But because of the other investors in this pool fund that are emotionally afraid to lose their capital, they'll be withdrawing the money. But because they are withdrawing the money, what does the fund manager have to do? He has to start selling. When at that point of time, it's the best time to actually go into the market and start buying. What happens to the investors who are emotionally stable, who understand the market, and who wants to grow wealth in the long term? They have to suffer the actions of the fund manager who has to sell all these funds to those who redeem. So, in other words, the profitability of the fund or your wealth is actually impacted by other people, which you have no control over, you see. But if you invest directly into stocks itself, who is in control? It's yourself. You know that at the best time to buy is when chip sale happens, when the market crash happens, you see price value divergence, you go in. And when the market is in a bull, that's when you gain capital gains and you profit and you exit. But not so in unit trust, you see.
Right, so hope that answers the question. Yeah. But we can do both, isn't it, if we wanted to?
Definitely you can do both, but just be aware of the fees, because that is something that we reserve for the next face-to-face or webinar. Do ask us that question again, because it will definitely take more than a few minutes to answer this question.
Okay, so the next question is also got related to do with other than investing in the stock market. Can we invest in properties instead? But let me answer this question, because hang on, we're going to have this stock versus properties webinar coming in the near future. So make sure you read your email and register for that particular webinar.
Correct.
Right, I think we have enough time here. There are still a lot of questions, but it's quite a more advanced questions, talking about cash flows and talking about net profits, talking about margins and so on and so forth.
Come to a face-to-face.
Yes, so John will be speaking in most of the events, and I will be speaking in most of the events in Bursa Malaysia. And again, Bursa Malaysia is providing this for the retail market players. So make sure you attend the workshops. If you want to see John again and ask him the questions directly, face-to-face with him, do attend the workshops. And I think, John, you will have a workshop in Penang on the 10th of March, and you'll be back in KL on the 17th of March. So you can see him back in KL on 17th of March and in Penang on the 10th of March, and you can see me in Malacca on the 10th of March. And also next month on the 15th of March, we're going to have another webinar. Please register as well. So, John, any last parting words?
Invest in yourself. That was the best.
All right, so good night, ladies and gentlemen. Thank you very much for joining us, and we'll see you again in our next webinar.
Happy Chinese New Year.
Happy Chinese New Year.